Hello, I am Barbara Ash, National Director of the Veteran Institute for Procurement, and I would like to welcome and thank you for joining us for this VIP webinar, SBA's Proposed Changes to Small Business Procurement. Will you be impacted? This webinar was developed with the goal to help veteran businesses accelerate growth in the federal marketplace. And that is what VIP is all about, accelerating the success of veteran-owned small business government contractors. And it is working. On average, companies grow 64% 1 year after graduating from the VIP program. VIP offers 3 different curriculums to give veteran-owned small businesses the tools they need to win government contracts. Programs are held in the Washington, D.C. area, just 11 miles from the White House. Participants receive hands-on, market-based instruction that helps establish best business practices for government contracting. And the program is offered at no cost to veterans nationwide. We currently offer VIP Grow, our core curriculum, VIP Start for veteran-owned small businesses looking to become procurement ready, and VIP expanded its curriculum and now offers VIP International to accelerate veteran small business success in the global marketplace. This webinar series is made possible thanks to the support of the United States Small Business Administration. Its goal is to provide resources to the 22 veteran business opportunity centers located throughout the country that support veteran-owned government contractors with entrepreneurial development services such as business training, counseling, and mentoring. And this is also a resource for the VIP alumni to ensure their continued success in the federal marketplace. Please note that the slides and audio from this webinar will be made available on the VIP website at nationalvip.org following today's presentation. Now it is my pleasure to introduce 2 leaders in their field, Tony Franco and Sam Finnery, attorneys with the Polare Mazza firm. Tony Franco is a senior partner with Polare Mazza and oversees their government contracts group. His more than 25 years of legal experience includes all aspects of federal government contracting, representing clients on a wide range of complex regulatory matters. Mr. Franco's practice also involves representing clients with protests and claims against the federal government and in disputes between prime and subcontractors. Mr. Franco primarily focuses on representing clients interested in pursuing opportunities set aside under preferential procurement programs, such as small businesses, 8A, HubZone, SDV, and women-owned small business programs. His practice also encompasses the representation of tribes, Alaska Native corporations. Please join me in welcoming Tony Franco. He is also joined by Sam Finnery, who is an associate with Polare Mazza and represents clients in a wide range of government contracting and litigation matters. His experience includes representing federal contractors in bid protests before the Government Accountability Office and the Court of Federal Claims, in size status protests before Small Business Administration, and appeals before the Boards of Contract Appeals. He advises clients on matters of regulatory compliance arising under the Federal Acquisition Regulation and SBA regulations, including affiliation mitigation avoidance and maintaining size and socioeconomic status. You are in excellent hands today, and I am again excited to introduce today's presenters, Tony Franco and Sam Finnery.
Hello, Barbara. Thank you so much for that kind introduction. It's really a privilege to be able to present for the VIP and all your attendees. It's always great to be able to contribute back to a community that has done so much for our country. You've done a great introduction, so I'm going to really quickly just skip to the next slide, which I believe. Want to make sure we have no technical difficulties issues here. Moving slides. I apologize to our audience. Yes, real quick. The earlier slide, just real quick, just background on the firm. We are a firm that is a full-service law firm that represents contractors in all aspects of their business needs. A significant amount of the work we do in this is in the government contracting sphere, but we also help clients with business and corporate litigation, and a wide array of the needs that most businesses have when they're engaged in government contracting and in the commercial world as well. Many of the participants in the VIP program know us, as we have had the privilege to present at so many of these events for you guys, and we do our best whenever we're trying to represent our clients, not only in the areas that we're really well known for, but others that many of our friends do not realize we also do because of our full service capabilities, which extend well beyond government contracting. This presentation, though, is going to be focusing on small business issues, and wanted to make sure that briefly we spoke about first certain small business and legislative developments that we believe are critical for all small businesses to be aware of. Many of your attendees may already be aware of those developments because they've been circulating for the last month and a half, but we're going to recap them here. Then we're going to go straight into these proposed rules that the SBA has issued, which is the reason why we put together this webinar, because it is so critical for the community to realize that there are changes taking place that may impact small businesses in so many different ways. During the course of the presentation, we'll also give you our thoughts on comments that were submitted to the SBA. The deadline to submit those comments was several weeks ago. We've already submitted comments, and we'll let the audience know what we've said that we believe are views that would reflect what most small businesses would think the SBA should be doing with these new regs. And then we'll take Q&As during the course of the presentation if we can, but if we're really moving this thing along, we may then at any point just continue with the presentation and then follow up with VIP and Barbara with regard to how we can get answers to any of the attendees who'd like us to drill down on a couple of questions. Now, turning to real quickly the latest developments on Capitol Hill that we want to make sure the community is aware of. First of all, as many of you may have heard, the Small Business Runway Extension Act of 2018 was signed in December by the President. And that law had a provision to change the way that small businesses are to calculate whether they qualify as small. Under the rules that have been on the books for years, a firm looks at its revenues or receipts for the last 3 years. However, Congress went ahead and increased that to 5 years. And this means that essentially there's now a law on the books that says that if you're going to determine whether you qualify as a small business on procurements that you're bidding on going forward, you can look back 5 years. That law was passed on December 17, 2018 when the President signed it, or it became effective. However, you should know that even though that law is in effect right now, the SBA has taken the position that it will continue looking at the rules that are in the SBA's regulations that provide for a 3-year look back. The reason for that is, frankly, the CM registration process has an automatic way that they calculate size, and they're going to have to modernize that. Also, there are certain regulations that need to be changed so that the 3 becomes a 5. I think the SBA could probably do this pretty quickly and simply, but the regulatory process can be prolonged, and we are getting a lot of clients calling us saying, what do they do? And it's a tricky situation because any company that certifies looking back 5 years, because that makes them small, could find themselves in hot water if they get protested, and the SBA takes a position that they shouldn't be doing a 5-year look back. This rule has also been somewhat controversial in that there are some companies who feel that this has really hurt them because if you go back 5 years, they now are large. And these are firms that were thinking that they'd be small, and being small is something that they prefer because they're more competitive in that market, and they can't compete with the large firms. And just because they slightly went over the size standard, they really can't qualify. They're no longer qualified for small business set-asides. In a nutshell, you should keep your eyes out peeled for any regulations that are issued by the SBA on this issue, because it is a big change in how it is sized is determined. The next thing you should be aware of is that there's a bill pending in Congress that would move the entire VA verification process for STVOs and VOSBs to the SBA. As many of you know, Congress actually had previously passed a law saying that it should be the SBA's criteria in determining management and control of veteran and service-disabled veteran-owned small businesses that should control. However, the VA still does its own CVE verification process for VA procurements. That only applies for the VA. For all other agency procurements, it's a self-certification process. If this bill becomes law, there's going to be a government-wide certification process. There will be no more self-certification as it's the case now, and the SBA would be certifying firms. Obviously, the issue here is going to be whether the SBA ultimately has the resources to do that. Then lastly, another law that we want to make sure everyone's aware of is that the 2018 NDAA did make some changes that are impacting HUBZone small business concerns, whereby many of them will now qualify for a longer period of time because the HUBZone program maps essentially have been frozen until January 1st. Also, there was a revision that the DFARS, with regard to the purpose of emphasizing quality, timeliness, and price reasonableness, which goes to a procurement rule. The simplified acquisition thresholds were also increased to 250,000, and the micro purchase thresholds were increased to 10,000, which means there may be more opportunities for some smaller businesses to go after some of these smaller contracts, given how easier it is for agencies to try to secure work through the processes in place for simplified acquisitions. Those are the big issues that have been going on in Capitol Hill that you should be aware of. Now, with regard to this proposed rule that prompted the setting up of this webinar, essentially what's happened here is that the SBA on December 4th, just a couple months ago, issued this rule that had been long awaited to implement provisions of the 2016 and 2017 National Defense Authorization Acts, and also the Small Entities After Disaster Act of 2015. The proposed rule deals with issues regarding subcontracting plans that normally, frankly, impact large businesses more than small businesses, but it's critical for small business community to be aware of these changes because there's a tremendous market for small businesses to be doing subcontracting work. And it's very clear that the government is trying to make sure that large businesses are sharing the wealth when they get these big government contracts. Also, changes in the non-manufacturer rule and IT value added resellers rule. This may not impact many of you. It depends on whether you deal with in these industries, but there are many government contractors that are impacted by it, so we will be touching upon it. Also, we'll be discussing set-asides within set-asides, which what we're dealing here is these big multiple award contracts that are being awarded these days, where there are a significant number of contractors that then need to compete with each other, and many agencies are essentially creating set-asides within set-asides. The SBA's had some issues with those in the past. The other issue that was addressed is a recertification rule, which is critical rule because companies need to be constantly monitoring whether they've engaged in an act that requires recertification, and there are certain triggering events that require recertification, whether you've done anything or not, that would trigger recertification under other rules. There's also a rule here that's being proposed with regard to the limitation on subcontracting, which, as you all know, is a very, very important rule for small businesses to make sure they comply with. And then there are rules relating to size determinations for small businesses and ostensible subcontractor affiliation, which is the big rule that oftentimes impacts whether a company that has won a contract can actually perform it, because the company may not realize that due to the affiliation, they now could be disqualified. And the SBA seems to be tightening up those rules. So that's what we'll be discussing in the next hour or 50 minutes that we have left. And I'm now turning it over to Sam, so he'll start getting into the substance of the proposed rules.
Thanks, Tony. The first topic we're going to touch upon here that was addressed in the proposed rule pertains to subcontracting plans. The proposed rule makes a number of changes with respect to these plans, the first of which is that it indicates that a contractor with a subcontracting plan that fails to comply in good faith with periodic reporting requirements or its duty to participate in studies and surveys as required by the contracting activity to determine compliance with those plans is now going to be considered a material breach of contract. This is pretty significant, obviously, because it is indicative of SBA's goal here to try and clamp down on compliance with these subcontracting plans. The proposed rule includes a couple of examples of what would constitute a failure to comply in good faith. One of which is a failure to timely submit subcontracting reports, failing to pay small business subcontractors, and failing to conduct market research, which would indicate whether small business concerns are available with which to subcontract. It also indicates that failure to make a good faith effort can be considered in past performance evaluations, which contractors should be aware of. And it further states that failing to comply could subject concerns with subcontracting plans to liquidated damages. Now, that being said, SBA indicated in the rulemaking that they're not aware of any case where a firm's actually been subjected to such liquidated damages for failing to comply, but it is certainly something to keep in mind, given that SBA is trying to enforce compliance with these plans. Another area that it affects is it indicates that contractors with commercial subcontracting plans now have to include indirect costs in those plans. These had been historically required, or contractors with these types of plans have been historically required to include indirect costs when reporting on their performance through the summary subcontracting report system. However, SBA's rules did not expressly require them to include indirect costs in their subcontracting goals, and SBA had indicated that this had led to some inconsistencies when comparing the summary subcontracting report to the commercial subcontracting plan itself. This, hopefully, by reporting indirect costs, should increase the small business subcontracting goal, which would then increase the amount of funds the prime contractor would have available to subcontract to small business concerns, and it should therefore allow agencies to negotiate more realistic commercial subcontracting plans. There's one final change that the proposed rule makes, and this is just sort of to conform the SBA regulations with regard to subcontracting plans to the FAR, which just indicates that compliance reviews pertaining to subcontracting plans will now use the terms exceptional, very good, and satisfactory as the FAR requires, instead of what is currently required, which is outstanding, highly successful, and acceptable. The next area that we're going to touch upon here is small business contracting in disaster areas. The proposed rule is now going to permit agencies to take double credit towards their small business goals when they award contracts to small businesses that are located in disaster areas, and therefore give those firms preference when working in those areas. Agencies will be able to take this extra credit through the typical agency scorecard process. The rule will use the definitions in the FAR for what constitutes whether a concern is located in a disaster area, which is if during the last 12 months it's had its main operating office in the area, and that office has generated at least half of the firm's revenues and employed at least half of the firm's permanent employees. This is important to consider because this should create not only opportunities for small businesses that are located in these areas, but also for large businesses that would like to have subcontracting or perform on subcontracts with small businesses located in these areas. So there should be a number of opportunities created by this proposed rule. It also provides a number of factors that SBA will consider if a firm does not meet the explicit criteria for what is considered located in a disaster area. Other factors that SBA will consider in determining whether you reside in a disaster area include the location of the firm, its current state licenses, its record of past work in the disaster area, its history with subcontractors in the disaster area, the percentage of revenues attributable to work in that area, and the number of employees that it has that are located in that area. There is also a clarification of the proposed rule that pertains to the non-manufacturer rule and information technology value-added reseller procurements. The rule just essentially confirms the size standard for ITFAR procurements, which are issued under footnote 18 to NICS code listed here in the slide, is 150 employees and not 500 employees. There's been some confusion in this regard in the past because the size standard for the non-manufacturer rule is 500 employees. This rule was, as indicated in the rulemaking, this rule has actually been issued in response to a recent size appeal where a firm unsuccessfully argued that the size standard for IT VAR procurements should be the 500 employee size standard applicable to the non-manufacturer rule. However, it's important to note that these IT VAR procurements are still subject to the non-manufacturer rule, which generally requires firms to be engaged in wholesale or retail trade. They have to be a small business concern under the size standard assigned to the contract. They have to be a regular dealer in the product to be offered, and they have to represent that they will supply the product of a domestic small business manufacturer or processor unless a waiver is granted. Essentially, to implement this rule, the SBA would amend the non-manufacturer rule to expressly state that a firm can qualify as a small business to provide manufactured products or supply items as a manufacturer if they do not exceed the 500 employee standard, which is the typical standard for the non-manufacturer rule. And they've added in this language here in quotations to indicate that the standard for IT VAR procurements would be 150 versus the 500. The rule also proposes to permit set-asides within a set-aside. As Tony touched on earlier, SBA has sort of come up against this issue in the past and has had problems with it. Essentially, what this would allow is if a agency issues a large IDIQ contract that's going to have task orders awarded thereunder, they can award, it would allow the agency to award the contract as a small business set-aside at the master contract level, and then conduct further set-asides thereunder for the task orders to be issued. So they could make a further set-aside within that set-aside for SDVOSB, WOSB, HubZone, or 8A task orders. It's important to note that this is a complete shift in current SBA policy. SBA in the past has indicated that these types of procurements are not permitted under the current regulations and should not be allowed because there's concern that this would be to the disadvantage of a small business that might be able to qualify for the IDIQ contract itself, but doesn't necessarily hold the socioeconomic status to qualify for the further set-asides issued thereunder. So you find yourself in a situation as a small business where you expend your time and resources to bid on and submit a winning proposal, and you get one of these IDIQ contracts that could potentially be very valuable for your firm, and then come to find out the agency thereafter starts issuing a lot of set-asides that you don't necessarily qualify for, and the value of that IDIQ contract is really taken out from under you. SBA did ask for comments in issuing this rule specifically to that point to confirm whether industry folks thought that this would be impactful to small businesses for the reasons that I just indicated. And we actually submitted comments, as Tony touched upon earlier, and we expressed the belief that this would be something that would disadvantage small businesses specifically. The ways in which SBA has suggested that this rule might specifically be implemented are somewhat interesting. They've essentially said that the agency could either establish set-asides simply at the solicitation task order level under a multiple award contract that's set aside for small businesses at the master contract level, or what they could do is essentially establish socioeconomic set-aside pools at the master contract level. It's interesting that this is the way that they're proposing it, because there are some procurement vehicles out there, such as Oasis is one that is essentially already set up in this fashion. So it calls into question the propriety of some large procurement vehicles out there that are already essentially operating within this structure that SBA is now proposing, indicating that those vehicles might not be complying with the current letter of the law. The rule also makes a clarification with regard to size recertification. It indicates that when proposing language to clarify that recertification is required on full and open contracts when awarded to small business concerns. It's also adding a recertification requirement for 8A participants and small disadvantaged business concerns, which are already present in the regulations for the other socioeconomic programs. These were rules were actually expanded. The recertification rules were actually expanded to the socioeconomic programs. There was a significant revision last May that added some changes to the recertification rules to those programs, but at that time, SBA did not extend them to the 8A program, so they are now proposing to do that in this rulemaking. And the rule also provides that a prime relying on a similarly situated sub cannot count the subcontractor towards its performance requirements if the sub recertifies as an entity other than that which it had previously certified. This last change is somewhat interesting because it does not specifically require the sub to recertify to its prime contractor or to the procuring agency. So it's a little bit unclear how compliance with this rule would be enforced, whether a prime is supposed to essentially monitor the recertifications made by a subcontractor.
And just real briefly, with regard to the size recertification rule, we did notice an oddity in the way the SBA proposed this regulation, because there's a whole section regarding small disadvantaged businesses, and these regulations have been on the books for years because there used to actually be a program for small disadvantaged businesses at the prime level, but that is no longer the case. And the way the SBA has tried to bring consistency across all these programs for recertification purposes has encompassed also what looks like recertification for SDBs. The problem we have here is that there really are no SDB set-asides, and so the issue was whether that rule is intended to apply to subcontractors. Keeping in mind that all 8A firms are SDBs, but just because you're not an 8A firm doesn't mean you may not qualify as an SDB. And large businesses do try to meet their subcontracting goals by bringing in firms that self-certify as SDBs. The issue that we see by this proposed rule is whether the SBA actually contemplates subcontractors to be recertifying, as that is not something we've ever seen in any of the rules. And it's unclear, and we're seeking clarification from the SBA on that matter. Now, the next slide is sorry, we're just kind of taking a second here. Appreciate that, Sam. It's a limitation on subcontracting proposed rule. And this proposed rule that the SBA has issued is focusing on the fact that the SBA does not think it is being forced enough, and it is proposing to require contractors to submit information to the contracting officers and monitoring compliance. This has been a brewing issue for years, as many of you may know. A small business has to perform a certain amount of the work with its own personnel traditionally. There has been a change in that rule also, in that now what the SBA is looking for is for how much actual receipts are being received by the prime as opposed to subcontractor. And there is a similarly situated rule, which is a way that a small business or 8A firm or WSB can meet the requirements of the limitation on subcontracting if they subcontract to another similarly situated entity. But because this is one of those rules where if a company violates it, they may find themselves essentially being seen as a pass-through. It's always been one of these rules that the government has not really been monitoring too carefully. It's assumed that people are operating in good faith and following it, but there have been laws that have been passed, or regulations that are beginning to put more of a bite on those firms that violate this rule. But because a lot of these things never surface, because if the government doesn't know about it, the SBA feels that there needs to be more reporting. And right now, contracting officers can at any point in time ask a small business to show how they're meeting with their requirements. What we have found, though, is that most of them really don't do that. And they don't do that because they just want the work to get done. And as long as they're getting the services that they've asked the contractor to do, they may look the other way. Or also, many of these contracting officers are just so overworked, understaffed, et cetera, that just monitoring the contracts that they have in place is all-consuming. So therefore, one of the things that the SBA feels is that they need to put the onus on the contracting officers to engage in the actual monitoring. There's been, by the way, debate as to whether the SBA should be doing this, the contracting officer should be doing it. The SBA believes that once these contracts are being awarded by the contracting officers, it should be the COs. We have basically indicated to the SBA in our comments that we do not believe that there should be any kind of mandatory compliance request, because as it is, there already is regulations in place that would penalize companies that violate the rules. As it is, small businesses have significant reporting requirements that just come from being a government contractor, and to add yet another one is, we think, going to be burdensome to them. We also question whether these contracting officers also have the resources. So we think that really contracting officers should, as they do now, have the freedom to ask any company to report if they start suspecting that there's been a violation of the rule. Keep in mind, too, that to the extent the SBA decides to go down the road of mandating compliance, they've done that already with regard to the mentor-protege program, where if a mentor and a protege enter into a joint venture, they have to provide certain certification compliance, certified compliance with certain rules applicable to the joint ventures they've established. And it's a way essentially of forcing these companies to tell the government, yes, we're doing this, we're following the rules. And if they lie, they lie. And then they could be subject to all kinds of civil and criminal penalties, which, by the way, could happen at any point in time when any company is asked voluntarily to submit, of course. But at the end of the day, if the SBA decides to go down this road of making mandatory that small businesses report to contracting officers or they're complying, we think what they're going to do is follow a process very similar to that which is currently in place for mentors and proteges that enter into joint ventures. Another important element of a revision to the limitation on subcontracting rule that the SBA has issued is they want to clarify when a contractor can be counted as an employee for limitation, for size and limitation of subcontract limitation purposes. The basis of this is a size policy statement that was issued in 1986 that the SBA basically laid out the 11 factors that the SBA may consider in determining whether an individual is an employee. And notably, under these factors, for size purposes, an individual paid through a 1099, which is normally viewed as a payment when you're dealing with an independent contractor, may be actually treated as an employee. So, this has resulted in some confusion regarding how these individuals who are 1099s should be viewed for limitation of subcontracting purposes, because a limitation of subcontracting rule basically provides that work performed by an independent contractor should be considered like a subcontract, and many would argue that the moment you are paying someone and issuing 1099s, they're not W-2 employees, so therefore you need to go ahead and treat those as subcontractors. In the government contracting world, as many of you know, especially small businesses, bringing people on board as employees imposes a lot of extra cost. And a lot of the work that's done is done by individuals who you 1099 them, but you're treating them as employees. And the SBA has recognized that over the years. And so they look at these factors that are in play. But one of the things that's happened here with regard to the size policy statement is that the SBA has determined that it's really going to come down to whether the procurement is being set aside with the NAICS code that it has a receipts-based size standard, or whether it's an employee-based size standard. And the rule, which we think is somewhat problematic, is that an independent contractor cannot be considered an employee and will always be deemed a subcontractor when the contract has been issued with a receipts-based size standard. And this is somewhat problematic because to the extent that small businesses want to use small individuals and little companies as their subcontractors to meet the similarly situated rule, it's going to be a problem, because if you're using individuals under this rule, they have to be treated as subcontractors. And the issue then is whether they really are small. Now, a lot of independent contractors are sole proprietors, so that's not going to be a problem on small business set aside. But that will be a problem with regard to any contracts that are being set aside for 8A firms, service-disabled veteran-owned small businesses, et cetera, because these other individuals, if they don't also qualify as such, can't be treated as similarly situated. And as Sam will discuss shortly, that's one of the rules that the SBA is essentially changing, because they want to make sure that a company that is using similarly situated subcontractors are similarly situated in every respect, not only for purposes of limitation of subcontracting purposes, but also for purposes of for size purposes. And they could subject them to affiliation issues, which normally don't apply to similarly situated. In short, the way the revisions make clear that the SBA size policy statement applies when determining compliance with the limitation of subcontracting rule, but they're going to be applying it differently depending on whether you're dealing with a revenue or employee-based size standard. Now, another big proposed revision is proposed exclusions for calculating compliance with the limitation of subcontracting clause. With regard to cloud computing, the SBA recognizes a lot of contracts that are being let require that small businesses use cloud computing entities to perform the work, and the SBA is thinking about excluding them from the determination. And the SBA actually specifically asked for comments on, what kind of what should be treated as cloud computing, whether that should be viewed as a supply. If it's a supply, would it then be subject to the non-manufacturer rule? Because if the value of the contract really is mostly for cloud computing services, they really should be setting this thing as the contract aside under a manufacturing code. The SB also proposed that media buys be deemed excluded, because some of these companies that engage in media buys, millions of dollars flow through them, and the way that those revenues should be counted would be a subcontracting cost. Also, with regard to the transportation disposal of environmental remediation firms, we have represented a number of them over the years who have told us that when engaging in environmental remediation around the country at many nuclear waste sites, they need to acquire subcontractors that have the unique capability to transport across the country very dangerous, hazardous material, and that is very, very costly. And they've indicated that even though they're working at a specific site, engaging in the environmental remediation, the fact that there's this element now having to transport it, that is a significant cost, and normally larger businesses are providing that service. So that really creates a problem for them in terms of meeting the requirements of the limitation on subcontracting clause. And then also travel. To what extent, if you have a contract that requires that you spend a lot of money traveling, should those costs really be, the revenues you receive to reimburse you for the travel, should they really be counting against you? The SBA requested comments on whether these types of costs should be excluded from the calculation. We agree that, frankly, the SBA should be looking not only at these costs, but that others. We did not receive too many comments from the community and when we were drafting the comments ourselves, because we did reach out to see what other potential lines of work should be treated as excludable. We know, for example, there are clients that have contracts that require that they provide IT services, but procuring agencies are all of a sudden issuing task orders for computers, and maybe $1 million or $2 million in computers. And that creates a huge problem for them, because they may not have the computers. They have to go to large businesses to get them. Why it is that these agencies are trying to get the computers through contracts that are for services? It's convenient. But that said, even though the comment period has ended, I would encourage companies that now can think of things that they believe need to be excluded to submit something to the SBA. The SBA, they have a deadline, but I think they'll be receptive to any good ideas that are brought forth by the community, because it'll take them months to actually issue a final rule, and there's a number of things they need that we believe tweak. Now, with regard to another proposed rule impacting limitation on subcontracting, that we want to make sure you're aware of is that on December 4th, the FAR Council, so this was not an SBA rule, so I'm shifting a little bit from the SBA's rule to a FAR Council rule, but it issued a proposed rule to bring the FAR into compliance with the National Defense Authorization Act, which changed limitation of subcontracting rule. And so I'm sure many of you, if not all of you, are aware, the SBA, under the current rules on the books in terms of the regulations, you determine compliance by looking at labor. What kind of labor costs are being split between the prime and the sub. However, Congress mandated through the National Defense Authorization Act in 2013 that formula be changed. And then instead you look at how much is being paid to the small business prime contractor, and they need to keep at least 50% of those receipts for themselves. You don't count material costs to the extent you have your small business and you have a contract that requires that you buy trucks, etc. The fact that you need to go to a large business for those trucks should not count against you. The bottom line, though, is that even though this law has been in the books and the SBA has actually issued regulations to implement it, the FAR has not been changed. And fortunately, and many procuring agencies have taken the position until the FAR gets changed, they wouldn't implement the new rule, because as the FAR was reflecting the old formula, which provided for looking at labor cost. There are FAR clauses that are incorporated automatically into many, to government contracts that provided for that other formula. So for these agencies, it was just a major headache to come up with their own, essentially, deviation from the FAR. So for them, it's just easy enough saying, no, we'll go with the old rule until the FAR gets amended, even though the SBA had a different rule. And that was creating a lot of confusion. The GAO actually had taken a position in a case that what mattered was the new rule, and if a company was applying with the new rule, they should be viewed as compliant. But fortunately, this is all now getting taken care of. And most importantly, on December 3rd, the DoD issued a class deviation that was effective immediately to implement the SBA's rule. And we think that's critical because there is just so many dollars going through the procurement system via the DoD. And so that really means that everyone's now operating under the same set of rules. The confusion should go away, and labor costs should not be an issue in determining compliance for you. It should always be the new rule. But remember, you've got to look at your contract and see what FAR clause has been incorporated.
Thanks, Tony. Turning back to the SBA proposed rule that we've been discussing, the next issue that the rule addresses pertains to ostensible subcontractor affiliation. Now, this is one of the most common size protest grounds out there. Ostensible subcontractor rule traditionally applies when you have a small business prime contractor that's unduly reliant on an other than small subcontractor, or when an other than small subcontractor is going to perform the primary and vital parts of the contract. When those circumstances are met, SBA will find those two firms affiliated, and therefore the prime contractor will not be eligible for award. What SBA is proposing now in this rule is they're going to make an offeror ineligible for a set-aside if the prime contractor has a small business ostensible subcontractor that does not qualify for the required socioeconomic status. So this would be the similarly situated situation that Tony was referring to earlier, where you've got, for example, you've got a prime contract that's set aside for SDVOSBs, and you have an SDVOSB prime that is subcontracting that work to a small business, but the small business is not similarly situated. They're small, but they may, for example, they're not an SDVOSB, maybe they're a WOSB or just a small business, a hub zone or an 8A or something of that nature. Traditionally, there had been no grounds to protest this situation, and so this rule will create a new protest ground. The reason that there had been no former way to protest this scenario is because SBA recently enacted a number of joint venture regulations under which a joint venture receives an exception from affiliation if both venturers are small under the applicable NICS code. So that would mean if you've got, for example, an SDVOSB contract that's awarded to an SDVOSB company, and that company then subcontracts most or all of the actual performance to a business that is small for the NICS code, but not an SDVOSB, there's currently no way to protest the awardee on ostensible subcontractor grounds, because if both the prime and sub are small businesses, under SBA's joint venture regulations, they're deemed a joint venture and are exempt from a finding of affiliation. So this rule will now indicate that whereas subcontractors, where you have this situation and the subcontractor is small and there is ostensible subcontractor affiliation on a non-similarly situated small business subcontractor, that can be grounds for a status protest of what's essentially being deemed now a joint venture. Or if the non-similarly situated subcontractor is a large business, you can now have grounds for a size protest. The distinction here essentially is that if you've got two small businesses, even if they're deemed affiliated under the ostensible subcontractor rule, they might not be large for the procurement, which is why in that case you could actually have a status protest that it's not, for example, an SDVOSB joint venture if the SDVOSB prime is unduly reliant on a WOSB subcontractor. The proposed rule also has an effect on kit assemblers. It's proposing to remove the kit assembler exception to the non-manufacturer rule. The existing kit assembler rule requires that 50% of the total value of the items in the kit have to be manufactured by small business concerns, but excludes items that are manufactured by other than small business concerns if the contracting officer specifies the items for the kit. This rule has led to a lot of confusion concerning how to calculate the total value and whether a waiver of the non-manufacturer rule has to be requested in order to supply items that are manufactured by a large business. So the proposed rule will instead apply the multiple item rule to kit assembler acquisitions. And under this rule, things are a little bit more straightforward. Essentially, if the majority of the items in the kit are made by a small business, no waiver of the non-manufacturer rule is required. And if majority of the items are not made by a small business, a waiver of the non-manufacturer rule has to be obtained. The last note here is that, like all other acquisitions, the non-manufacturer rule does not apply to, and I want to make a distinction here in the slide. The slide says the non-manufacturer rule does not apply to set-asides. The non-manufacturer rule does not apply to small business set-asides at or below the simplified acquisition threshold, but it will apply to other types of set-asides at or below the simplified acquisition threshold for, for example, an SDVOSB or 8A set-aside. The proposed rule also has a clarification on when size is determined. It's not really a change so much as it's just clarifying that size is determined generally at the time of initial offer or a response that includes price. The current rule has led to a little bit of confusion just in the way that it's worded. It says that size is concerned as of the date of initial offer, and then in parentheses in the rule it says or other formal response to a solicitation, end parentheses, which includes price. This has led to some confusion as to whether other responses such as revised revisions would be the date that's locked in for determining size. So it's essentially the clarification is that size is not determined when other formal responses are received after the initial offer, such as final proposal revisions. It is when your initial offer is submitted, including price. There's one proposed exception to this rule, which would be when an agency awards a multiple award contract that does not require offers for the contract to include price. In that situation, size will be determined on the date of initial offer for the contract, which may not include price. The last issue upon which the proposed rule touches is that it clarifies what contracting officers are supposed to do when one acceptable offer is received on a set-aside procurement. It confirms that if the CO receives one such offer, that they should make award to that firm. Now, the FAR currently provides a similar rule, but it only indicates that the CO should make award in such a situation for set-asides that are below $150,000. SBA doesn't believe that there's any policy reason why there should be a cap for when a CO should or shouldn't make award when they've only received one acceptable offer. They've essentially indicated that the decision made by a contracting officer to set aside is based on that contracting officer's expectation from market research that it's going to receive 2 or more fair market offers from capable small business concerns. So this is the rule of 2. So essentially, as long as the market research leads the CO to this conclusion, the rule of 2 has been satisfied, and SBA thinks that it shouldn't make any difference how many offers are actually received for that procurement. The only thing that's important is that based on their market research, it indicated that they would receive 2 or more. So if you have a situation under the proposed rule where you've got a large procurement and only 1 acceptable offer is received, it now provides that regardless of the value of that procurement, the CO should make award. SBA, essentially in their rulemaking indicated that they think it'd be inefficient and detrimental to the government and offerors to arbitrarily prevent an award where there was a competition conducted but only 1 acceptable offer was received.
Now, this is one of those rules that I see that there's a potential for some abuse. Now, we do think it's great that if you're a small business and you've competed for a contract and it just so happens you're the only one that submitted an offer, I mean, the agency doesn't just walk away after you put a lot of bid proposal cost into the effort. But I could see situations where a procuring agency conducts market research, but the market research may not be that thorough, and a number of companies, that all work together on other matters decide to indicate to a CO that yes, they're interested in this contract. So now the CO has a file indicating that according to the market research, or at least 2 firms, and because of the rule of 2, they need to set aside the work for 2 firms. Yet these companies really, all of them, only one is going to submit an offer, and that's the one that's going to get the work. And who knows to what extent that one company now gives subcontracts to the other companies who led the contracting officer to believe that there was going to be more than 1 offer. So it'll be interesting to see how this all plays out. But we do think, though, having seen so many companies that do put a lot of time into submitting proposals, that it's a shame when they basically don't have an opportunity to get an award that they worked hard for, simply because other companies just didn't have the wherewithal to pursue the contracts. Now, just the one last slide we have here is that, the comments were due on February 4th. Given the breadth and scope of the proposed rules, there were so many many nuanced issues that needed to be addressed. We tried to hit as many of them as possible, if not all of them. But if you would like, please feel free to go to our webpage and you can pull a draft of our comments, which will explain these rules in some more detail and provide some feedback as to how we think the SBA should be moving forward with regard to these proposed rules. And after you've read them, if any of you have any questions, you want to follow up with us, or even take them and cut and paste some of those arguments and go back to the SBA and say, look, you may have missed a deadline, you're a small business, but that you think that these are important issues. And feel free to make different arguments, of course. Again, even though, it may be after the fact, I believe that SBA always wants to hear from the small business community. Now, with regard to questions, Sam, why don't you pick one of these questions out so we can...
Sure, yeah. I think just one thing we want to generally make clear at the outset here, based on some of the comments that we've received during the presentation, we just want to make sure that everyone's aware that this is just a proposed rule. These rules have no binding, they're not effective yet whatsoever. So they could change based on the comments that SBA essentially will, now that the comments period's closed, they'll review and assess the comments. They may thereafter, really there's no firm timeline, but they may modify the rule and issue a modified final rule that adopts some of the comments from the industry, maybe some of our comments, may change some of the rules, may eliminate some of the proposed rules. Alternatively, they might not issue a rule at all and might walk back from all of this. But given the scope here, that there's definitely a pretty good likelihood that a bunch of these rules are enacted in some form. But just be aware that they aren't currently effective when trying to navigate government contracting arena as it currently stands. I also want to indicate, know there's been a couple of comments about one of the slides we touched on earlier. One of the rules that is being proposed here is to permit set-asides within set-asides, and I think that our discussion on that prompted a little bit of interest from the attendees. And I just want to say that, if there's any contracting officers that might be listening today, want to make clear that SBA has very firmly indicated in the past that as it currently stands under their regulations, set-asides within set-asides are not permissible. Currently, they've commented on this in the past. They've chosen not to permit the very rule that they're now proposing in the past, which is why we were so interested in that proposed rule and submitted comments indicating, the effects that we think the rule will have on small businesses. But just be aware that currently there's pretty strong indication from SBA and precedent out there confirming that those are not valid procurements. So if any contracting officers or industry folks see of such a procurement, just be aware that that's certainly, if there is a set-aside within a set-aside that's issued right now, it could lead to a pre-award protest and, could cause that type of procurement to not be allowed, as it's not currently permitted or contemplated in SBA's regulations. Well, I don't see any other additional specific questions here for Tony or I, but if any of you have any other questions in the last closing minutes here, we'd be happy to address them to the extent we can. If anybody wants to submit some comments.
Sam, this is Barbara. Getting back to your comment on that last question, a set-aside within a set-aside, if they do see that is not the policy right now from SBA, what should be their next step?
Well, I guess that's specific depending on who it is that spots it. If it's, I guess we would want to make contracting officers aware just what the current regulations are, and that they, SBA's regulations currently don't, the FAR in general just currently doesn't provide for set-asides within set-asides. And, SBA has provided commentary in the past indicating that those are not valid procurement vehicles. So if it's a contracting officer, we would just advise them to be aware of the regulations and what they mean. If it's a potential offeror, it could be grounds for you to consider a pre-award protest based on the terms of the solicitation. If the solicitation is a task order solicitation that's being awarded under a IDIQ multiple award contract that's been set aside for small businesses at the master contract level, and that's that's something that your firm's not going to be eligible to submit a bid for, it's certainly grounds for a pre-award protest based on the terms of the solicitation not being a currently permissible procurement. Tony, if you have any additional comments.
Yeah, what I would add, though, the only thing that would, I think, preclude a successful protest there is if the solicitation, when it was issued, put all the small businesses on notice that they were going to be doing set-asides. Because if you are competing for a contract as a small business with a lot of other small businesses, but upfront that as this 5 or 10-year contract moves forward, that they are going to be doing set-asides within set-asides, it's going to be argued that you've waived the right to protest. And this issue regarding the SBA not liking set-asides within set-asides, arises, I believe, in large part because of the fact that there was a pattern here of agencies doing 8A set-asides, where these task orders really were not being offered to the SBA for acceptance. Now you have 8A companies competing for the work. The SBA was taking the position that because these were not really accepted into the program by the SBA, by the 8A program folks, that therefore these agencies should not be taking 8A credit. So companies really were not protesting it because they probably were told by their attorneys, or they, for political reasons, you don't protest sometimes, or they were told, look, you're going to get dismissed because you should have really protested the set-aside within set-aside language in the solicitation. And so they may just have determined that, yeah, they were never going to be in on every competition. And for 8A companies that are now just competing with other 8A companies, the fact the SBA has taken this position means that the way the SBA has been looking at it is the 8A regulations that apply to 8A contracts don't apply, which is very interesting because what that means is, for example, if you are performing an 8A contract and your company is sold, you really need to go through a process to get the SBA to sign off on that. There are very strict rules regarding the transfer of 8A contracts or the change of ownership in 8A companies. And so when many companies have 8A contracts, they are very careful in terms of what they do in the M&A market. But if the government's taking the position, the SBA, that, oh, these are not really 8A, the agencies just can't take credit, for them, that may be a win-win, because now they're not really subject to all these 8A rules. They're only competing with other 8A companies for these contracts. And sure, the agency may not get the credit, which for them may have been the reason they did it, but nonetheless, it may make the competition that much better for these agencies that perhaps have a pool of 8A companies that they think are really, really good, and they want to get them the opportunity for the work. So it's a tricky one, and I think the SBA realizes that they don't want to be fighting with the procuring agencies on different vehicles that are out there to get work. But they are going to create certain processes so that there's some more monitoring and everybody knows they're playing under the same rules.
Well, thank you so much. Thank you, Tony and Sam. We are out of time. There are a few more questions you didn't get to, and we'll certainly work with you to get those answers and provide them to the community as soon as you have an opportunity to review them. Again, thank you for this excellent presentation on SBA's proposed significant changes to small business procurement. And I want to thank our participants for attending the VIP webinar and to the SBA for making this webinar possible. Again, we hope you found the information presented to be helpful as you prepare your company to compete, comply, and perform in the federal marketplace. I would like to ask that you take a moment to complete this very short survey that will be sent to you immediately following this program. Your feedback is always very important to us. Again, thank you to Tony and Sam from Polera Mazda for your excellent presentation and insights on these proposed rules. I want to thank you again, and thank you to everyone who participated, and we wish you all continued success in 2019. Have a great afternoon.
Thank you, Barbara.
It stopped, yeah? Yeah, I did that already.
Okay.
I ended the webinar and then leave the webinar. Yeah, end webinar. That's what I did.
Can you start this one?
I did.
Okay.
I have to hide both of them. Let me mute us.